If you want to understand what's actually happening right now, stop watching silver price charts. Stop listening to the headlines. Stop refreshing CNBC. Because the most important shift didn't happen on a trading screen. It didn't happen on Wall Street. And it definitely didn't happen in a soundbite. It happened quietly, in supply chains, in factories, in data centers, and in places most investors never look. Here's the uncomfortable truth. Almost everyone is reacting to what silver did. Very few people are asking why it suddenly can't go back. For decades, silver was treated like a side character. Too boring, too slow, too irrelevant. Something you owned if you were old-fashioned, paranoid, or both. Now it's moving faster than assets that were supposed to represent the future. That should make you pause. Because when a dead asset wakes up this aggressively, it's usually not because of hype. It's because something underneath the system has shifted. Quietly, structurally, and irreversibly. Most people think this story is about price. It isn't. It's about function, it's about dependence, and it's about a system that suddenly realized it needs something it no longer controls. If you're still trying to decide whether this is a bubble, you're already behind. The real question is different. What changed now, after 40 years of nothing? Pause. Watch closely. We'll unpack it step by step. Most coverage you'll see right now is surface level. It treats silver like a ticker symbol instead of a system component. You'll hear phrases like speculative flows, momentum trade, or retail enthusiasm. That language sounds analytical, but it misses the point entirely. Because those explanations assume the market is behaving normally. It isn't. Mainstream analysis is trapped in a price-first mindset. They look at charts, volume, and sentiment indicators, then work backward to invent a story that fits the move. That works when markets are stable. It fails when markets are undergoing structural stress. What's actually happening has very little to do with excitement and a lot to do with constraint. Silver isn't rising because people suddenly want it more. It's rising because key parts of the global economy are realizing they need it, and they can't substitute it. That's a fundamentally different dynamic. In a normal market, higher prices bring out more supply. Producers sell more. Holders take profits. Balance returns. But silver isn't responding that way. Supply isn't showing up. Inventories aren't refilling. And price increases aren't calming demand. They're accelerating it. That's your signal that something structural is breaking. Most commentators are still debating whether silver is overbought. They're asking the wrong question. The real issue isn't valuation. It's availability. When an asset shifts from being optional to being essential, price stops acting like a guide and starts acting like a warning light. And right now, that light is flashing. Not because of speculation, but because the system itself is tightening. To understand what comes next, we have to leave opinion behind and look at verifiable facts. That's where we go next. Let's slow this down and look at what can actually be confirmed. As of mid-January 2026, spot silver has reached the mid-$90 range, marking the highest nominal price in history. That move followed a rapid climb from the low 70s at the start of the year, representing a gain of more than 30% in less than 3 weeks. Regardless of interpretation, that pace alone places the move outside normal historical behavior. On the supply side, global silver production has remained relatively flat. Annual mine output over the past several years has struggled to grow meaningfully, constrained by declining ore grades, higher extraction costs, and long development timelines. New primary silver mines take many years to permit and build, and most silver is still produced as a byproduct of copper, lead, and zinc mining. That limits how quickly supply can respond to price. At the same time, above-ground inventories have been tightening. Publicly reported exchange inventories in major trading hubs have shown sustained drawdowns, not replenishment, even as prices rise. This is atypical. In past cycles, rising prices usually encouraged inventory holders to sell metal back into the market. On the retail side, physical product availability has been inconsistent. Government-minted bullion coins have faced repeated production suspensions and allocation limits. Premiums on coins and small bars have remained elevated, suggesting stress at the retail distribution level rather than oversupply. Industrial demand has also remained firm. Solar manufacturing continues to consume a significant share of annual silver supply, and electric vehicle production uses materially more silver per unit than internal combustion vehicles. These uses are not discretionary. Silver is chosen because of its electrical and thermal properties, not price convenience. Investment demand has added another layer. Silver-backed investment products have recorded extended periods of net inflows, indicating sustained buying interest rather than short-term trading. Importantly, these inflows have occurred alongside rising prices, not falling ones. On the monetary side, gold prices have also remained elevated, trading well above historical averages. The gold-to-silver ratio has compressed meaningfully compared to prior years, signaling that silver has been gaining relative purchasing power rather than simply tracking gold upward. None of these data points, taken individually, are unprecedented. What is notable is their convergence: flat supply, declining inventories, persistent industrial demand, strong investment inflows, and rising prices that are not relieving pressure. These are observable conditions. They don't rely on opinion, narrative, or speculation. They describe a market where physical constraints are becoming more relevant than financial assumptions. With the factual groundwork established, the next step is interpretation, not in emotional terms, but in strategic ones. When you step back and view these facts together, a different picture begins to form. This combination of flat supply and rising demand suggests that silver may be transitioning from a market driven by price discovery to one driven by access. In other words, the question may no longer be, what is silver worth, but who can still get it, and on what terms? One possible interpretation is that we're seeing the early stages of a repricing driven by necessity rather than enthusiasm. Industrial users, particularly in energy, electronics, and advanced computing, do not participate in markets the same way investors do. They don't buy because they expect upside. They buy because production depends on it. If that's the case, higher prices may not meaningfully reduce demand. They may simply shift purchasing behavior upstream. Instead of buying on open exchanges, large users may seek direct agreements with refiners or suppliers, removing metal from visible markets before it ever reaches public price discovery. This could help explain why reported inventories continue to decline even as prices rise. Rather than flowing back into the system, metal may be bypassing it entirely. Another implication involves financial institutions. Historically, banks and trading desks have treated silver as a highly liquid paper market, suitable for leverage and short-term positioning. That approach assumes that physical supply can always be sourced if needed. If that assumption weakens, risk management behavior may change. This may indicate why we're seeing more volatility around new highs. Price spikes followed by sharp pullbacks can be consistent with defensive repositioning rather than pure speculation. In such an environment, price becomes a battleground rather than a signal. There's also a broader strategic layer. Governments and corporations have become more sensitive to supply chain fragility over the past few years. The shift away from just-in-time logistics toward redundancy and stockpiling changes how critical materials are valued. Silver, because of its unique properties, may be increasingly viewed as a strategic input rather than a simple commodity. None of this guarantees a straight line upward. In fact, transitions like this are often unstable. Periods of rapid repricing tend to invite volatility, policy responses, and financial stress. What it does suggest is that the underlying role of silver may be changing faster than most analytical models account for. If silver is being reclassified, informally, from a discretionary material to a strategic one, then many legacy assumptions about pricing, availability, and market behavior may no longer apply. And when assumptions break, systems adjust, often unevenly. To understand what that adjustment could mean on a larger scale, we need to widen the lens. When a material shifts from being plentiful to being constrained, the effects don't stay contained within one market. They ripple outward, touching systems that rely on stability and predictability. In financial markets, sustained volatility in a foundational commodity introduces friction. Pricing models that assume liquidity and mean reversion become less reliable. This can increase risk premiums across related sectors, from mining equities to industrial manufacturers. Over time, uncertainty itself becomes a cost. For banks, especially those involved in commodities trading or financing, constrained physical supply complicates balance sheet management. When paper claims are easier to create than physical delivery, any mismatch becomes more visible during stress. This doesn't automatically lead to failure, but it does force more conservative behavior, higher margins, reduced leverage, and tighter credit conditions. At the currency level, rising precious metal prices often reflect declining confidence rather than isolated demand. Gold and silver don't move in a vacuum. When they rise together, it can indicate that investors are questioning the durability of fiat purchasing power. That doesn't mean an immediate collapse, but it does suggest a gradual erosion of trust. Governments face a different challenge. Industrial policy increasingly depends on secure access to critical inputs. Energy transitions, digital infrastructure, and national security planning all intersect with material availability. When a key input tightens, policymakers may respond through subsidies, stockpiles, trade restrictions, or strategic partnerships. These responses can further distort markets in the short term. On a global level, unequal access matters. Countries with domestic resources or strong refining capacity gain leverage. Those dependent on imports become more exposed. Over time, this can reshape trade relationships and investment flows, especially as competition intensifies in high-tech sectors. What's important here is not the idea of crisis, but of adaptation. Systems rarely break all at once. They bend, strain, and reconfigure. Silver's behavior may be signaling one such reconfiguration, where materials once treated as abundant are being reassessed under new technological and geopolitical realities. If that's true, then the consequences aren't limited to investors or traders. They extend to how economies plan, how companies build, and how governments prioritize. That brings this discussion closer to home, because macro shifts only matter insofar as they affect real lives. Big macro shifts can feel abstract until they show up in everyday life, but they always do, just not all at once. When material constraints start influencing markets, the first place most people feel it is purchasing power. Prices don't rise evenly, essentials tend to move first. Energy costs, utilities, transportation, and anything tied to infrastructure feel the pressure before discretionary spending does. That's because these systems can't pause demand when inputs get more expensive. For households, this often shows up as a slow squeeze rather than a sudden shock. Savings don't disappear overnight, but they stretch less. The same paycheck covers fewer contingencies. Financial plans that worked in a low volatility, low-cost environment start to feel outdated. For workers, especially in manufacturing, technology, and construction, supply stress can cut both ways. Some sectors benefit from increased investment and hiring as companies scramble to secure capacity. Others face instability as costs rise faster than revenues. Job security becomes more uneven, even within the same industry. Investors feel it through correlation breakdowns. Assets that once moved together stop behaving predictably. Traditional diversification feels weaker. Long-term plans based on steady growth assumptions require reevaluation. Not because they were foolish, but because the environment changed. Families also feel this in planning horizons. Decisions about housing, education, retirement, and relocation start to carry more weight. When uncertainty increases, flexibility becomes valuable. Liquidity matters, but so does resilience. This isn't about fear, it's about alignment. Periods like this tend to reward people who understand systems over people who chase trends. Those who pay attention to inputs, dependencies, and constraints are better positioned than those who focus only on headlines or short-term price movements. The key is not to predict every outcome, but to recognize that the rules of the previous decade may no longer apply cleanly to the next one. Which raises an important question. How do you think clearly in an environment where signals are noisy and narratives are unreliable? That's where having a framework matters. At Boring Currency, we don't try to predict prices, we don't chase narratives, and we don't react to headlines. We use what we call the structural lens. The structural lens is a way of filtering the world that asks a different set of questions than most financial commentary. Instead of asking, what is going up, we ask, what has become necessary? Instead of asking, what do people believe, we ask, what can't be substituted? This framework rests on three core principles. First, dependency beats sentiment. Markets can ignore opinions. They cannot ignore physical requirements. If a system depends on an input to function, that input eventually asserts power, regardless of how boring or unfashionable it once seemed. Second, constraints matter more than forecasts. Forecasts assume flexibility. Constraints remove it. When supply cannot respond quickly and demand cannot step aside, volatility is not an accident. It's a signal. Third, systems move before narratives catch up. By the time something is widely explained on television, it has already happened. Structural changes begin quietly, often dismissed, until they reach a point where price is forced to adjust. The structural lens doesn't tell you what to buy or sell. It tells you where to pay attention. It helps you distinguish between noise and pressure, between excitement and necessity, between trends and foundations. Once you adopt this way of thinking, you stop being surprised. You may not know the exact timing, but you understand the direction, and more importantly, the reason. That perspective is what allows people to stay calm while others react emotionally. And it's what allows preparation to replace prediction. Next, we translate that mindset into practical, real-world value. Practical value doesn't come from bold predictions. It comes from positioning yourself so that fewer outcomes can hurt you. In environments shaped by constraint and volatility, the first priority is reducing fragility. That means avoiding situations where a single price move, policy change, or supply disruption can force a bad decision. Leverage increases fragility. Overconcentration increases fragility. So does relying entirely on assumptions that worked in a different decade. The second priority is observation. Instead of reacting to price, pay attention to behavior. Are shortages being acknowledged or denied? Are institutions adjusting rules, margins, or access? Are companies changing how they secure inputs? These shifts often matter more than daily market moves. Third is optionality. Optionality isn't about timing the top or bottom. It's about preserving the ability to act when conditions change. That may mean maintaining liquidity, holding assets that don't require constant management, or avoiding structures that can be closed or settled by someone else's decision. Fourth is patience. Structural shifts rarely resolve quickly. They unfold unevenly, with periods of calm followed by sharp adjustments. People who feel pressured to do something during every move often exhaust themselves and their capital before the system finishes rebalancing. Finally, separate signal from identity. Markets have a way of pulling people into camps: bulls versus bears, believers versus skeptics. Once your identity is tied to being right, it becomes harder to adapt. Staying flexible is not a weakness, it's an advantage. None of this requires perfect foresight. It requires discipline. It requires thinking in terms of systems rather than slogans. And it requires the humility to accept that uncertainty is permanent, but fragility is optional. Which brings us to the end, not with answers, but with a clearer way of seeing. What we're watching right now isn't just a price movement. It's a reminder that systems don't fail loudly at first. They shift quietly until the adjustment becomes visible to everyone at once. For years, silver sat in the background because it was easy to ignore. It didn't demand attention. It didn't tell a compelling story. And in a world obsessed with speed and novelty, that made it invisible. Now, it's visible again, not because it's exciting, but because it's necessary. You don't need to panic. You don't need to predict the next number on a screen, and you don't need to agree with every conclusion. What matters is awareness, understanding that constraints shape outcomes, that dependencies create pressure, and that stability is often an illusion we recognize only after it fades. If you can hold that perspective, calm, informed, and patient, you're already ahead of most reactions-driven thinking. The goal isn't to win a trade. It's to navigate change without being forced into decisions you didn't choose. Stay observant, stay grounded, and remember, the most important moves often happen long before they're explained. We'll keep watching.